Hello and welcome to Moneylife News and Views. I'm Debashis Basu. Are we in a sustained bull market? Well, a few months ago, even thinking about a bull market seemed all crazy. But all over the world, the stock markets have been rising steadily since the frightening two-week crash in March. The Nifty and Sensex have risen almost 40% from the bottom of the market, which is on 23rd or 24th March, even though the economic prospects all around is quite bleak. So are we in a quiet new bull market? It's true that while we are fixated on the immediate past and the current situation, the market usually looks ahead. But a more plausible explanation for the bullishness that we find here is the bigger, bolder and much greater rally that's happening in the US market. And that is what is influencing the markets here to go higher. So the question then is, what is fueling the US market? Well, one is the belief that we're going to have a vaccine very soon for COVID. There are a lot of promising results coming out from various tests that people are doing. And the second reason is that if for some reason the US economy gets worse or the COVID situation gets worse, the US government, that's the Federal Reserve, is willing to pump in trillions of dollars of more money into the economy, and that is very good for stocks. Now, alas, neither of these two arguments are applicable in India because the cost of vaccines would be very high or exorbitant, in limited supply, and by the time it really comes down to, become used for common man, it's going to be years and years and years. And secondly, the bigger reason is that India has no money. India is a poor country, so it has no money to flood the economy with cash. So all this leads to this very, very critical issue. If life in US returns to normal, it will be a healthy normal for them. Please remember that before COVID hit them, the US had the lowest unemployment rate in 50 years. Corporate taxes were among the lowest in the world, and companies were flush with funds. Was that the situation in India? No. Every single sector, whether it's infrastructure, capital goods, real estate, metals, finance, auto, they were all in the grip of a very severe slowdown. Now, for a stock to go up, it has to have tailwinds. For a lot of stocks in the market to go up at the same time, in a sustainable manner, the economy must enjoy tailwinds. When analysts and fund managers talk of being bullish for the long term, they assume very strong economic growth. That is why they have assumed every year for the last several years, naively believing the pronouncements and promises of ministers and secretaries are going to lead to a major economic boom. Unfortunately, they have been wrong year after year after year. Now, based on the expected growth, analysts have also been projecting double-digit earnings for companies, better companies, which are there in Sensex, Nifty, and other major indices. But they only found the figures they were projecting are way off the mark. The actual performance is much, much worse. Well, it's worth remembering that the market index has barely doubled in 10 years. That I'm talking of Nifty and Sensex, which means a compounded annual growth rate of just about 7%. Taking the peak index in January, it was still only 8.7%, and you can add about 1.5% of dividends to that. But that's it. That hardly beats the bank FD. How have so many smart people got it so wrong repeatedly? Well, analysts and fund managers are usually blind to the influence of macroeconomic factors on corporate performance. They remain very narrowly focused on the projections of the financials of companies in the years ahead, without going into the deeper economic reasons of those reasons which will influence the corporate performance that they're projecting. This is why a well-known large equity fund has bet a lot of investors' money since 2012 on stocks like State Bank of India, capital goods, various public sector companies, hoping for the economic growth to spurt. The result was a major disappointment for this fund. All through 2009 and 2015 period, consumer goods companies, financials were enjoying strong tailwinds, and along with pharma companies. which came from government spending, generous loans advanced by public sector banks, and other international reasons. This created an economic expansion and partly, in my opinion, a false boom, for which we are paying the price now in terms of the huge bad loans in banks. Where was the economic expansion of that kind before COVID? None. We were in a period of economic contraction, and that to which a lot of people remain blind to just now. And that explains, of course, the poor index returns of the recent years. There is another huge false belief among analysts and fund managers. This is very important. It is that economic growth, even if it is there, will automatically translate into better corporate performance. Now, this is the arithmetic that they believe in. If the economy grows at 6%, that is the GDP growth at 6%, and that is inflation adjusted, and if the inflation is 5%, then 6 and 5, 11% is a nominal growth rate. Okay. Now, this will be reflected. If the whole economy grows at 11%, obviously a lot of good companies are going to grow at much higher rate, and they would possibly grow at 15% or so, their revenues. Now, this hasn't happened. This is actually absolute nonsense, as is evident from a single-digit growth in revenues in a period when India's GDP growth was 7% and above, and inflation was around 8%. And the largest and the best Indian companies have not been able to grow revenues at 15% per annum or 20% per annum, as these numbers would suggest. Now, if these companies can't grow their revenues, at least by the nominal growth at which the whole economy is growing, then either the GDP figure is wrong, which we blindly believe in, or the theory itself is wrong, which is GDP growth translates into corporate revenue growth. But this belief is still very strongly held, even though this evidence is really staring us on our face. In a way, the situation today is the exact opposite of what it was in 2008, 2009, with which a lot of people are comparing our current market crash and subsequent recovery. Today, the market is rising effortlessly while we have huge economic headwinds. In 2008, the market was crashing for global reasons, and the economic expansion was still on track. So exactly the opposite situation. In fact, in November 2008, in a conversation with Moneylife, I remember Aditya Puri, managing director of HDFC Bank, telling us that Diwali, they had one of the highest usage of debit cards for purchases. The economy was doing so well actually at that time. That is not the situation today. Of course, we will get a very big one-time boom in pent-up demand. The moment the lockdown is lifted, you'll see a tremendous amount of purchases, where people are going out in the streets and sort of enjoying themselves. Maybe restaurants will open up, and that's going to lead to a tremendous amount of short-term boom. But remember, the economic normal before COVID was already very weak, and until that changes, we are not likely to have a very sustainable bull run. Thanks for watching.